It's tax season once again, and many Americans are keeping a close eye on their bank accounts to see when their tax refund will hit. But what's the best thing to do once you get your money back from Uncle Sam? On this IBD Explains, we ask, should I invest my tax refund? And here to help us is IBD's personal finance and management editor, Matt Krantz. So, Matt, what should I be doing if I get some money back from the government?
So the good news is, if you're like most people, you're going to be getting $2,933 back from the government, which is great because we're used to at tax time paying out money to the government instead of getting it back. That's enough money to really make an impact on your financial picture. In fact, there are three main things that you can use this money for. You can either boost your savings or your emergency savings. You can pay down your debt, or you can use it to invest, or better yet, all three combined.
Let's talk about maybe some of the primary ways we can use this refund, of starting with savings. Why is it important to build up emergency savings right now?
It's actually kind of shocking to hear that over a third of Americans have more in credit card debt than they have in emergency savings. So that means if something bad happens, something happens to your car, something happens to your roof, or whatever else will keep you up at night thinking about, these people haven't saved enough to cover for those expenses, which means they'll go further into debt. So the key is to have at least 6 months of emergency funds on the ready. And the tax refund is a great way to kind of get you started on that if you're not there already. It's money you wouldn't have had anyway. So you kind of put it in a rainy day fund and you'll know it's there for you later.
And as we've seen the news about interest rates climbing over the last year or so, but how are those higher rates maybe helping people that are saving?
Great question. So you can very easily now put money in a high yield savings account without even trying. You can get at least 4%, 3.5%, which is really amazing because it was basically zero a year ago. You just take a little bit of time to get a high yield savings account, or you could even buy a short-term bond ETF, which is basically no risk, and you get about 3.5, 4%. So it's really a great time to be a saver.
Now, let's say I want to put this tax refund to maybe paying down some credit card debt. Can you talk a little bit about why that might be a good option for some people?
Yeah, so higher rates, as you pointed out, are great for savers, bad for people who are spending too much money. If you're carrying a credit card debt, you're usually paying about 20% interest rates, which means by the time you get done paying this bill off that you've been accumulating, you're going to pay so much more for that thing that you bought than you thought you did. So the key is to use this higher interest rates as a way to make money on your savings, but use it as an incentive to pay down debt, because if you don't, you're going to be the one basically paying the high yield rates to the savers.
Right. And it's so important to get those high interest debts paid off. But is there maybe a danger to focusing on debt too much or having too much of an austerity mindset?
Absolutely. That's a fantastic question. In fact, the market returns, generally speaking, about 10% a year. And if you put money away now, it can really build up over your future. And if you use too much putting it in savings, even though the savings account rates are much better than they were, it's nowhere near 10%. So it's very important, as you point out, to kind of mix it around a little bit. What we're talking about is investing half of what you get back, which might be a little high, but a good place to start. Using about 25% to kind of bolster your savings and 25% to pay down that debt. And that's a pretty good mix to kind of put that refund to good use. And remember, if you get one next year, you get one next year, you get one next year, all these things will kind of accumulate over time.
Looking at that hybrid approach, if I do want to invest some of this money, what vehicle should I be looking at, or what may be the best vehicle for that?
Yeah, so it really depends. But with this kind of money, I think what's best is you kind of set it and forget it. And ETFs are great for that. An ETF that owns the S&P 500 or the NASDAQ composite is really great. So the SPY, super low cost, you put it in there, you let it roll for about 20, 30 years, and before you know it, you're getting 10% a year per annum. And in 20 or 30 years' time, that's actually kind of going to be a lot of money. And I think you'll be really satisfied. And you won't have to put a lot of effort into it either. So you can focus on making money instead of trying to invest it.
Well, Matt, thank you so much for your time today. We really appreciate it.
Thanks so much.